Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, The Guardian and The Challenger go head-to-head on "Your portfolio is 97% foreign, the case for buying more Britain." Let's get into it.
The average UK investor now holds less than 5% of their portfolio in UK stocks. You live here, you earn in pounds, you'll draw a pension in pounds, and yet 97% of your equity wealth depends on foreign markets. That's not diversification, that's abandonment.
It's not abandonment, it's rational. The FTSE 100 gained 42% in 26 years. The S&P 500 did that in the last 2 years alone. If you'd put 10 grand into a FTSE tracker in 2006, you'd have roughly £26,500 today. The same money in the S&P. Over £60,000.
You're cherry-picking your starting point. 2025 proved the consensus wrong. The FTSE 100 was one of the best-performing major indices last year while the Magnificent Seven stumbled.
1 year. You're hanging your argument on 1 year. Zoom out and the picture is brutal: a quarter century of underperformance against virtually every developed market.
Fine, let's zoom out. The dividend gap is enormous. UK equities yield around 3.6% versus 1.3% for the S&P 500. Over decades, those reinvested dividends compound into a massive difference that your simple price-return comparison completely ignores.
The dividend trap. People love that 3.6% yield, but high yields often signal low growth. Companies paying out that much cash aren't reinvesting in their businesses. American firms buy back shares and fund R&D, that's why their total returns crush ours.
But those dividends are real cash in your pocket, paid in pounds, with no currency conversion. Which brings me to my next point: currency risk is real. When sterling strengthens, your US returns get eaten alive.
Currency cuts both ways though. Sterling has been on a long-term weakening trend against the dollar, which has actually boosted returns for UK investors holding US stocks. You're framing currency as a risk when it's been a tailwind.
A tailwind that can reverse overnight. Ask anyone who was fully invested in dollar assets when the pound snapped back from its 2022 lows. You lost months of gains in a week.
Sure, but let's talk about what you're actually buying with the FTSE 100. You're not even buying Britain. Over 75% of FTSE 100 revenues come from overseas. Shell, HSBC, AstraZeneca, these are global companies that happen to be listed in London.
That's actually a strength, not a weakness. You get global revenue diversification with a UK listing, UK dividend tax treatment, and UK regulatory protections. Best of both worlds.
Best of both worlds? Where's your tech exposure? Where's your AI? The sectors that matter for the next 20 years, technology, semiconductors, cloud computing, they're almost entirely absent from the London market. The UK is banks, oil, and mining.
The valuation discount tells you everything. UK stocks trade at a massive discount to US peers. We're talking single-digit P/E ratios versus 20+ for the S&P. You're paying a huge premium for those shiny tech names.
And hear me out, UK stocks are cheap because they deserve to be cheap. Low growth, old economy sectors, shrinking IPO pipeline. London hasn't attracted a major tech listing in years. Companies are actively delisting to go to New York.
That's a sentiment argument, not a valuation argument. When everyone agrees something is uninvestable, that's historically been the best time to buy. Mean reversion is one of the most reliable forces in markets.
Japan waited 35 years for its mean reversion. Are you telling people to sit in underperforming assets for a generation hoping the market comes around?
Japan is a completely different situation: demographic collapse, deflationary spiral, a bubble that made the dot-com era look modest. The UK has none of those structural problems.
The UK has Brexit, a stagnant productivity record, and a brain drain of its best companies to US exchanges. Those are structural problems.
And yet UK companies keep raising dividends. The income stream is real, it's growing, And for someone drawing down a pension in pounds, that matters far more than whether Nvidia hit a new all-time high.
Until those dividends get cut. Remember 2020? BP, Shell, the banks, they all slashed payouts. The yield looked great right up until it didn't.
And they rebuilt them quickly. That's the resilience of UK dividend culture. American companies have no such culture, they'd rather buy back shares to inflate earnings per share.
Buybacks are just tax-efficient dividends. The money still flows to shareholders, it just doesn't get taxed twice. That's not a flaw, it's financial engineering that actually benefits investors.
Look, I'm not saying go 100% UK. I'm saying that 3% to 5% is absurdly low for someone whose entire financial life is denominated in sterling. A home bias of 15% to 25% is perfectly rational.
And I'm saying even that's too much. The UK is 3.3% of a $103.6 trillion global market. Overweighting it just because you live here is the same logic that made Enron employees hold all their retirement savings in Enron stock.
That's a ridiculous comparison. We're talking about an entire national market, not a single company.
The principle is the same, concentration risk driven by familiarity bias rather than fundamentals.
Fundamentals like a 3.6% yield, single-digit valuations, and proven dividend growth. Those are the fundamentals telling you the UK is the bargain hiding in plain sight.
And my final point is simple. Your portfolio should own the future, not the past. The UK market is structurally tilted toward yesterday's economy, and no amount of dividend yield compensates for missing the industries that will drive returns for the next 30 years.
The Guardian, The Challenger, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.